What happens when the American dream starts missing payments? Across the country, cracks are showing, not just in the economy, but in the very states we once called unstoppable. Rising debt, failing infrastructure, vanishing jobs. It's like watching a slow-motion car crash in high definition. Some states are wobbling, others are quietly collapsing, and a few are just pretending everything's fine while the house burns down behind them. So today, we're counting down the 10 US states most likely to fall first when the next big crash hits. And trust me, the results are not what you'd expect. Number 10, Nevada. Nevada has long been famed for spectacle, the lights, the casinos, the promise that fortunes can change overnight. But in 2025, the state's economic show is showing unexpected cracks. The housing market, especially for condos and multifamily units, is cooling in key metro areas like Las Vegas. Recent reports from Las Vegas realtors show that condo and townhome prices in the valley have dropped. As of September 2025, the median price is around $294,000, down 1.8% year over year, and drifting away from earlier highs. Some also report slight monthly dips. Meanwhile, single-family home prices in southern Nevada have dipped to a median of $470,000, down 2.1% from the same month last year. This signals that broader softness is affecting multiple segments of the market. Part of the pressure comes from oversupply and weaker demand. Active listings have climbed, and homes are lingering longer before closing. That shift means buyers have more leverage now. In a market once defined by bidding wars and upward momentum, discounting and patience are becoming the new normal. But beyond real estate, Nevada faces deeper structural stress, especially around water. Lake Mead, the lifeblood of southern Nevada's water supply, is under severe strain. Federal projections suggest the reservoir could dip below 1,050 feet by mid-2026, triggering harsher water cuts. That would force stricter conservation measures, reducing water allocations for homes, agriculture, and growth alike. Nevada already faces mandated reductions in its water draw under Tier 1 shortage conditions. Water stress isn't just environmental, it's economic. It limits growth, strains infrastructure, and makes long-term development riskier. For a state whose boom depends on expansion, tourism, and desert luxury, that's a dangerous shift. Combine that with inflation squeezing middle incomes, rising building and maintenance costs, and waning investor appetite, and you get the picture. Nevada's condo boom might be over. The house has stopped winning. Number 9, Michigan. Michigan was once the backbone of America's industrial might, the state that built the cars, powered Midwestern prosperity, and anchored the nation's economy. But by 2025, the engine is sputtering. In the last decade, Michigan has lost tens of thousands of residents to outmigration. In 2023 alone, the state saw 20,000 people leave for other states, more than double the losses in 2022. Florida remains the most popular destination. The projections are sobering. While Michigan might continue slight population gains through the early 2030s, by 2050, it is expected to decline to about 9.9 million people, a drop of roughly 128,000 from current levels. On the housing front, things don't exactly scream crash, but they certainly whisper caution. Zillow reports that the average home value in Michigan is about $257,784, up roughly 2.8% year over year as of mid-2025. Redfin data shows that median home prices in Michigan rose 5.9% year over year in August 2025, with rising sales and modest inventory growth. The All Transactions House Price Index, missed HPI for Michigan, also shows upward momentum. Q2 2025 is at an index of 562.95 compared to 535.29 a year earlier. Still, those aggregate numbers mask deeper fragility. Many younger Michiganders, professionals especially, are opting to leave in search of warmer weather or stronger job markets. That brain drain erodes demand for housing, retail, and services in middle and smaller sized cities. Meanwhile, the state's aging population, declining birth rates, and constrained natural growth add long-term pressure. The number of K-12 children is projected to decline about 18% by 2050. Michigan's economy remains uneven. Auto manufacturing and union sectors are still powerful, but they're under stress from global competition, automation, and shifting energy costs. Add in infrastructure challenges, especially in water systems and roads, and many smaller cities feel like they're paying repair costs with stagnant tax bases. In short, Michigan isn't collapsing yet. The housing market is modestly strong in many areas, supported by limited inventory and steady buyer demand. But the demographic headwinds, outmigration, and uneven economic base are flashing warnings. If demand softens or interest rates bite harder, some metro and suburban condo and multifamily sectors could face real stress. Number 8, Arkansas. Arkansas often flies under the radars, lush forests, small towns, and slower pace. But behind that scenic calm lies deep structural fragility. As of 2025, about 15.4% of Arkansans live in poverty, a figure that places it among the nation's higher poverty states. Many more households struggle. Nearly 41% of households in Arkansas can't consistently make ends meet, combining those officially in poverty and those in the ALICE, Asset Limited Income Constrained Employed bracket. Rural counties in Arkansas are seeing population loss. In the 2025 Rural Profile of Arkansas, it's documented that 48 rural counties have had significant decreases in population in the past decade. Simultaneously, the state today has 172 medically underserved areas, many in rural communities where healthcare access is extremely limited. Healthcare is a systemic challenge. Rural Arkansas suffers from scarce doctors, closing rural hospitals, long travel times for basic care, and underinsurance. One report noted that in many rural counties, the number of primary care physicians is far below what's needed. In addition, nearly 25% of working-age adults in Arkansas report having no health insurance, particularly when cost or access is a barrier. Economically, a small number of large corporations, Walmart, Tyson Foods, J.B. Hunt, anchor Arkansas's national identity, but they don't necessarily drive local prosperity in rural areas. Outside of metropolitan corridors like Bentonville and Little Rock, job growth is sluggish. Many small towns struggle to retain businesses or to attract investment. The state's infrastructure also lags. Roads deteriorate rapidly, broadband access is inconsistent in rural zones, and local budgets are stretched thin. Arkansas also faces educational and demographic headwinds. As families leave rural areas, tax bases shrink, schools lose funding, and local services degrade further. A feedback loop that makes recovery harder. The health and well-being disparities across counties are stark. The 2025 county health rankings report persistent gaps in health outcomes tied to income, access, and geography. In short, Arkansas is not in collapse yet, but many of its regions are teetering. Widespread poverty, shrinking rural populations, healthcare deserts, and aging infrastructure combine into what looks like a slow, creeping spiral. Without bold interventions, the state risks slipping from quiet deterioration into something much darker. Number 7. Alabama. If the United States had a hard mode setting, Alabama's been playing it for decades. It's a state of contradiction, rich in history, culture, and natural beauty, yet burdened by some of the worst poverty, health, and infrastructure metrics in the country. On paper, Alabama looks stable. Low unemployment, relatively affordable housing, and a solid industrial presence. But when you scratch beneath the surface, the cracks are deep and widening. In 2023, the median household income in Alabama was just $62,212, a figure that ranks about 20% below the U.S. median. Meanwhile, many rural hospitals are on the brink. Reports show that more than half of Alabama's 52 rural hospitals are currently at risk of closure, with 19 labeled immediate risk. It's a deeply worrying sign when the places meant to anchor community health and employment are themselves vulnerable. Healthcare is not just a matter of access, but of survival. Some rural hospitals have already cut inpatient or emergency services. In fact, since 2010, at least 14 rural hospitals have fully closed, and many more have reduced essential services. Meanwhile, 74% of rural hospitals operate with negative margins, making it nearly impossible to stay afloat. Even labor and delivery care is scarce. Only 15 hospitals statewide still offer full 24/7 labor and delivery units. Outside the cities, rural Alabama deals with stagnation. Industrial jobs that once anchored county economies have largely moved on. Town centers age, population drifts away, and many counties lose both tax base and political influence. Educational systems are under stress. Teacher shortages, funding gaps, and declining enrollment numbers all contribute to cycles of disadvantage. Infrastructure is aging, roads and bridges struggle, and broadband access remains uneven, especially in remote areas. And yet, Alabama is not yet failed. It still carries spirit within its people, in its small towns, in its resilience. But that resilience wears thin without structural change. If investment, policy, and commitment don't follow, the story of two Alabamas, one advancing, one forgotten, may no longer be hypothetical. Number 6. Kentucky. A state rich in character but increasingly strained by economic fault lines. On paper, parts of Kentucky still hum. Lexington has life, Louisville has culture. But beyond the city limits, much of Kentucky is grappling with stagnation, decline, and legacy industries in retreat. As of 2023, Kentucky's poverty rate is about 16.1%, slightly down from earlier peaks but still well above the national average. Child poverty is even more severe, particularly in Appalachian and eastern counties. In eastern Kentucky's 5th congressional district, the poverty rate as of 2024 is estimated at 24.3%, far above the state norm. The collapse of coal remains one of the biggest structural blows. Between 1990 and 2016, coal production in eastern Kentucky plunged roughly 85%, causing massive income losses, business closures, and cascading local economic declines. That region's shift away from mining hasn't been met by equivalent new pillars of growth. Healthcare and social services have grown, but often in struggle. As one Hazard Kentucky physician warned, as coal fades, people now depend on Medicaid, hospitals, and clinics, meaning any cuts threaten not just health, but jobs. Kentucky's median household income has seen modest gains. In 2024, that figure rose to $64,526, up from $61,118 prior. But the increase isn't uniform. Median income for black households trails at around $47,881 compared to $66,749 for white households. Meanwhile, the rate of uninsured Kentuckians nudged upward in 2024 to 6.8% after Medicaid coverage drops. Healthcare access remains uneven, particularly in rural and eastern Appalachian counties. Many communities cite hospital staffing, closures, or reduced services as ongoing threats. Funding, infrastructure, and workforce constraints all weigh heavily. Education, too, struggles under funding gaps, teacher shortages, and declining enrollment in outlying areas. In the cities, Kentucky has glimpses of revival. Urban cores attract investment, people, and the promise of more diversified economies. But those gains are rarely felt in the hills and valleys of Appalachia. Over time, the result may be more pronounced divergence. A Kentucky of growth and aspiration side by side with a Kentucky of decay and quiet decline. Kentucky still holds strength, legacy, community, culture, but unless the state can bridge its divides, invest strategically, and create opportunity in its overlooked corners, its economic engine may sputter further before it ever revs again. Number 5. Louisiana. Louisiana is a state built on resilience, always repairing levees, rebuilding after storms, reimagining its future. But in 2025, that resilience is being tested like never before. Louisiana is now among the fastest shrinking states in the US. Its population has dropped by about 0.9% overall, as many parishes lose residents year after year. Over the last 3 years, the state's population fell by more than 84,000 people, with Caddo Parish alone losing over 11,000. Insurance is a crisis in slow motion. Since Hurricane Ida 2021, Louisiana's nonprofit state insurer has seen rates climb by 164% on average, while private insurers withdraw from coastal markets. As flood and storm risks rise, many homeowners can't find affordable coverage, and lawmakers recently shelved bills that might have given relief to struggling homeowners. Meanwhile, nearly 500,000 Louisianans face losing flood insurance entirely if federal support (NFIP) isn't extended. The state's geography is also working against it. Coastal erosion has cost Louisiana nearly 1,900 square miles of land since the 1930s, roughly the size of Delaware. Wetlands vanish, storm buffers vanish, and communities become even more exposed to each new hurricane. New Orleans, once a cultural and economic beacon, embodies the contradictions. The French Quarter buzzes, tourists still flock, but behind the scenes, many locals bear crushing costs. Crime, infrastructure decay, high insurance, and shrinking middle-class opportunity weigh heavily on the city's backbone. Industrially, Louisiana has long depended on oil, gas, and petrochemicals, but that sector is shrinking, hit by global energy shifts and automation. Towns like Houma, Morgan City, and others in South Louisiana were once energized by fossil-fueled jobs. Now they're trying to stay afloat as demand shifts and facilities consolidate or shut down. Poverty remains entrenched. Louisiana's poverty rate hovers near 19%, placing it among the highest in the country. In many rural parishes, poverty, underemployment, health challenges, and infrastructural neglect combine into a vicious cycle. Despite all this, Louisiana keeps rebuilding, because what else can it do? But rebuilding without deep systemic change is like patching cracks in a levee with tape. At some point, you have to reconstruct the foundation. Number 4, Mississippi. If Louisiana is struggling to stay above water, Mississippi has been wading through it for generations. Mississippi ranks among the poorest, least healthy, and slowest growing states in the US. But when the numbers land, the state often acts surprised. According to the U.S. Census's 2023 estimates, Mississippi's median household income is $54,203, which places it well below the national average. Poverty remains pervasive. About 1 in 5 Mississippians live below the federal poverty line, and in many rural and Delta counties that rate rises much higher. In places like Sunflower County, over 32% of residents live in poverty. The median household income there is just over $40,000. Yazoo County likewise sees more than 30% of its population in poverty. Mississippi's rural hospitals are under severe threat. Of 74 rural hospitals statewide, 34 are financially strained and at risk of closure, and 25 are considered in imminent danger of shutting down in the near future. Recent reports also flag that 8 hospitals could close due to cuts in Medicaid reimbursement and financial pressure posts. The state has repeatedly declined to expand Medicaid, worsening funding gaps for safety net care in rural areas. Infrastructure and basic services are also deteriorating. Jackson's water crisis in 2022 exposed how fragile the state's systems are. Many smaller towns still rely on aging pipes, underfunded utilities, and roads that deteriorate faster than they can be repaired. The state ranks among the lowest in health outcomes nationally, with high rates of chronic disease, limited access to care, and a persistent shortage of medical professionals, especially in rural regions. Educational challenges compound the issue. Underfunded school systems, teacher shortages, and outdated facilities limit opportunity. Many young people see few prospects and leave for neighboring states. That exodus weakens tax bases, shrinks local consumer demand, and accelerates decline in small towns. Yet Mississippi still holds intangible strengths: cultural depth, community identity, a history of resilience. But grit alone won't restore infrastructure, healthcare, or sustainable economies. Without renewed investment, strategic policy shifts, and meaningful capacity building, the state risks slipping from long-term stagnation to irreversible contraction. Number 3. West Virginia. West Virginia is a state that feels like it has been hollowed out from the inside. Once fueled by coal, industry, and small-town vitality, it now wrestles with population loss, job decline, chronic poverty, and a shrinking social safety net. From 2010 to 2020, West Virginia lost around 59,000 people, a drop of 3.2%, making it one of only a handful of states to lose population in that decade. That trend continues. Between 2022 and 2023, the state's population fell another 0.47%, going from about 1.79 million to 1.78 million people. Meanwhile, median household income in 2023 rose modestly to $55,948, but poverty remains stubborn. 16.7% of West Virginians live below the official poverty line, including 20.1% of children. Coal, once the economic lifeblood, is now a shadow of itself. In 2021, coal mine employment dipped below 12,000 workers, hitting the lowest level since the late 19th century. Some counties historically reliant on mines are now in persistent poverty. For example, McDowell County has a median household income of about $28,235 and a poverty rate exceeding 37%. In fact, McDowell's home values are so low that many properties are listed under $60,000, reflecting the severity of local decline. The job base outside extractive industries is thin. The mining and logging sector in West Virginia currently employs just over 20,800 people, seasonally adjusted, a far cry from its peak. Layoffs continue. In the summer of 2025, about 700 jobs in coal-related operations were eliminated across the state, including closures in McDowell County. Counties deep in Appalachia show extreme income disparities. In some, median household income falls below $28,000, more than 40% under the state average. The losses in population have pressured local services. Schools are consolidating, healthcare providers are closing or cutting services, and many counties struggle to maintain infrastructure or broadband access. Despite billions in federal aid and occasional investment in tourism or remote work initiatives, the scale of decline is vast. West Virginia still retains tremendous natural beauty, cultural pride, and grit, but those assets alone cannot replenish leaving talent, reverse decades of disinvestment, or restore towns emptied by economic collapse. Number 2. Colorado. Colorado still rides a reputation. Mountain vistas, outdoor freedom, a booming tech corridor, but the narrative is quietly shifting. Rapid growth is slowing, migration is cooling, and the economic momentum that once made Colorado seem unstoppable is showing signs of strain. For much of the past decade, Colorado stood out among states for its high incomes and fast population gains. The median household income now ranks in the top 10 nationally, filled by counties along the Front Range. But that prosperity is uneven. Wealth is increasingly concentrated, housing costs are surging, and many rural and outer areas are being left behind. Population growth, once a sure bet for Colorado, is decelerating. In 2025, net migration into the state is down more than 50% since 2015. Fewer people are choosing Colorado as their new home. Many counties are now losing residents. In the 2021 to 2022 period, 28 of 64 Colorado counties, 44% saw population decline. Projections still show growth over the next decade, but with much more dependence on local births than migration. Economically, Colorado's expansion is grinding slower. In recent quarters, the state ranked in the bottom 10 for GDP and home price growth, slipping behind peers. Job growth is modest. In January 2025, non-farm employment grew by 0.8% over the year, behind the US average of 1.3%. Wage gains continue, but they often don't keep pace with rising costs, especially in housing and inflation. The state also faces serious fiscal pressures. Forecasts for 2026 to 2027 show a projected budget shortfall of $698 million, even before considering recessionary risk. And when housing, infrastructure, and services demand expansion, but revenues are squeezed, something has to give. Meanwhile, metro cores like Denver are still growing. From 2020 to 2024, the Denver metro added about 2.8% in population, approximately 82,000 new residents. But even there, the pace is much slower than earlier in the decade, and population declines in surrounding counties suggest the gravitational pull is weakening. Colorado's boom state status is evolving into a more complicated story. Growth continues, but it's no longer assured. The costs are rising, migration is cooling, and inequality is deepening. Unless the state adapts, investing in housing, diversifying beyond high-cost metros, and supporting its rural peripheries, Colorado might slip from model of success into a cautionary tale of overreach. Number 1. California. California still looks like the future until you check the dashboard. After a pandemic-era exodus, population decline has eased, and 2024 even ticked positive thanks to stronger international inflows. But net losses to other states remain large by historical standards, and growth is no longer doing the heavy lifting. At the same time, unemployment sits elevated near the mid-5s, and job creation has cooled below the national pace. That shift shows up in slower GDP and housing momentum along the Front Range. The Front Range is Denver. In California, it's the coastal metros, where affordability remains a structural drag despite a late summer price rebound. Housing is the pressure valve and the pain point. The statewide median home price hovered just under $900,000 in August 2025, up slightly year over year, yet ownership is further out of reach for median income households. Inventory has loosened versus last year, but not enough to normalize costs, and the insurance market has become a second affordability crisis, with major carriers restricting new policies in high-risk zones. Fair plan enrollment has surged. Lawmakers are advancing stopgap fixes, and new legislation aims to stabilize last resort coverage after costly wildfire seasons. The social strain is visible. California accounts for roughly a quarter to 28% of the nation's unhoused residents, with 2/3 unsheltered, by far the highest rate in the country. Even as statewide homelessness rose more slowly than the national jump last year, the baseline burden remains extraordinary, complicating downtown recoveries and local budgets. Meanwhile, migration patterns have reset. Departures to lower-cost states have normalized from pandemic peaks, but continue to sap working and middle-class households, while international arrivals partly backfill coastal counties. None of this erases California's structural strengths, scale, innovation, global capital, and top-tier universities, but it reframes the risk. With growth slower, unemployment higher than the US average, housing and insurance still punishing, and homelessness persistently elevated, the state is managing a high-wire act, sustaining prosperity without the tailwind of breakneck in-migration. The question for 2025 isn't whether California is resilient, it is, but whether policy and supply can relieve costs fast enough to keep that resilience from fraying. From collapsing coal towns to California's housing gridlock, one truth stands out. America's foundation is shifting, and some states are running out of time to fix the cracks. If you value honest housing insights, hit subscribe and tell us in the comments, which state do you think is next to crumble?